Hi guys, and welcome to the first part of a new mini-series that we're starting. And the name of this series is called Central Bank Digital Currencies, Are They the Missing Key to Globalization? This series is going to cover what roles central bank digital currencies could play in a sort of macro environment, moving money across borders, as well as helping to speed up the velocity of money for interbank settlement and domestic settlements. Because a lot of the CBD stuff is all about the velocity of money, which is where central banks can really come in. I think it's the missing key. So over this series of 5 videos, we're going to cover what central banks do, how they keep their reserves and how they fund, how they operate domestically and non-domestically, what role CBDCs could play moving forward, and how CBDCs can prop up the commercial banking sector. And again, it's all about the velocity of money. So we're going to break this up into 5 shows, be like a daily watch for you. And we'll crack it off from there with just, this episode is all about what a central bank is and what a central bank does. And because we've all got one, well, the majority of countries have got one. Sort of, well, certainly the G20 countries. So I'm in the UK, obviously our central bank is the Bank of England. If you're in the States, it's the Federal Reserve. But we're going to dispel a couple of myths on they're independent, because ever since we got rid of the gold reserve, they're less independent than they used to be. So when currency was pegged to gold, it wasn't pegged to a sovereign currency, so it wasn't pegged to any debt. It was pegged to a physical asset. And the central banks were a lot more independent because they use reserves to peg currencies, FX rates. Since they moved it to a more debt-based system, which is how the financial system works now, we work purely in a debt and credit system. So the government will issue a debt, the central bank will then buy and issue reserves. So it's all about the treasury notes, the bonds, the yields, and it's an intertangled mess now when it used to be a lot more straightforward, which is why CBDCs will play such an important role moving forward. So a central bank, to me, it's a lender of last resort. So if we go to what central banks do and who they are a lender of last resort. When commercial banks can't support the economy and don't have the liquidity and can't perform domestic banking and functions, and there isn't enough money in the system, then the central bank steps in. They also play a massive role in monetary policy. Now, monetary policy is set out by the countries every year. In the States, you'll have your budget, and you'll quite often hear Congress going, we're going to raise the budget ceiling, which means that they're going to have to increase their debt levels. They'll do that by generating treasury notes, which will then go to the Fed, and the Fed will issue currency on those treasury notes. And or not necessarily the Fed, they'll sell the debt, which is how the system works now. But they'll issue debt, and that debt will be sold. The problem we get is when people don't buy the debt, then it's very difficult to raise capital from selling treasury notes, which is why we've got inverted yields and why yields are spiking here, there and everywhere. But that's, a job of a central bank. It's to maintain a monetary policy for the country. Now, a budget will be set out. The central bank will work with government to make sure that that policy is fulfilled. In the States, they concentrate very, very heavily on employment. So the higher the employment figures are, as in the less people are unemployed, then the better, and they're meeting their mandate, because that's a growth mandate from the government to say we're going to support as many jobs as possible, which supports the economy in as many ways as possible. And the Central Bank of China, their primary job is to keep their currency pegged below the dollar to make their exports more appealing than the imports. And that's, again, a massive role of the central bank in China. In the UK, we've got a mandate to keep inflation at 2%. It's a target inflation rate. And again, that's the job of the central bank. So these are all things that the central bank do that goes behind the scenes. And a lot of it does go on behind the scenes. So we'll all have the budgetary meetings, and we'll all hear that the meeting to discuss the interest rates, which are a very hot topic at the moment, because obviously interest rates are increasing because that's the only real tool that the central bank have got to fight inflation. And they do that by creating a saving environment as opposed to a spending environment. People think the problem at the moment is inflation's going up and everything's becoming more expensive. Now, that's actually happening because there is an excess of liquidity in the system. So when you look at housing prices, when you look at your goods, your CPI index, which is your consumer price index. When you look at all of those figures are being driven by a monetary bubble because we have created too much liquidity. And the central bank has to rein that in, and the only way they can rein that in is by making the cost of borrowing more expensive and taking that liquidity out of the system. So we've had a very long spell since 2008 of what we call quantitative easing, which is when the central bank makes the delivery of liquidity very, very, very cheap. In most cases, it's been almost free for commercial banks to borrow money. It's not been free to the user. We still pay 17% on credit cards. We still pay 3 or 4% on mortgages. But it's been very cheap for commercial banks to actually take that liquidity from the central bank. And then they can reissue that capital and they charge their interest. So the banks have done very well during all of this. But now it's going to be a little bit harder for the banks to make money. We've just heard that JP Morgan had their second quarter, which was ended in July, and their investment banking arm is down by 70%. So that gives you an indication of how much less money they're making on lending and providing liquidity in the system. These are all, again, jobs of the central bank. Whatever the monetary policy is by the country that's been set out, and whatever the target inflation rate is, whatever the unemployment figures are, however they need to support growth of the country, that is their job, it is their mandate. They're very much a partnership as opposed to being independent with the government now. So again, during Trump's administration, there was an awful lot of backwards and forwardsing between Trump and Powell, where Trump was trying to apply a bit of pressure for Powell to actually steer his way. He had to do it anyway because they have a mandate and they have to hit that mandate. So it's much more of a collaboration. The central bank can say no if they can't support fiscal policy. So they are supposed to be independent in the way that they address monetary policy. So when all the meetings are going on and when the Chancellor is backwardsing and forwardsing and discussing what's going to come up in next year's budget, it's down to the central bank to say, okay, we can support that, we can hit those targets, or we can't hit those targets. It doesn't happen as much anymore, as I say, because we're in this debt system and the central bank's hands are tied. They do have tools available to them, which we'll discuss later on in the series. But for the most part, they have to support a government's monetary policy and they have to support a government's growth campaign because it's also in their interest to do so. Nobody wants their economy to shrink. I don't necessarily agree with the whole 2 consecutive periods and you're in recession, because when that comes around, it's like you updating your car and your kitchen and your windows and everything else every single year. It anticipates that you are constantly growing. And obviously through cycles of birth and cycles of death and cycles of sort of monetary easing and monetary tightening, it doesn't necessarily need to be that you have to be growing. We can set targets that, for me, are below what we're currently achieving. So if we've grown by 2% this year, we could actually set a target that we're going to grow by 0.1% this year and give yourself that gap, as opposed to just constantly giving yourself this target of constant growth, because it's the perception of everything's okay and everything's doing well, and it isn't, if we're being honest. Everything's being propped up at the moment by the issuance of an awful lot of debt, and debt is supporting growth. But that debt eventually is going to come due, and we've been doing it now for 14 years, since 2008. When we look at the American national debt clock and everyone sees that debt's ticking up and ticking up and ticking up, it's not necessarily a bad thing for the states, because the states are selling that debt to somebody else. China's central bank owns about 3 trillion. Europe own 1.2 trillion. Japan own 1.4 trillion. A lot of that debt is held offshore by overseas investors and other governments that hold reserves of the USD currency, because it's the reserve currency. Again, it's a central bank's job to use those reserves to maintain their own FX rate, their own exchange rates. So when we look at exchange rates, we look at how the currency is fluctuating against the dollar, because it's the reserve currency. Again, it's the central bank's job to maintain your sovereign currency's exchange rate in comparison to everybody else. So you'll see that during Brexit, the UK had a real hard time because a lot of people were selling their UK debt. They didn't want it anymore. They didn't have any faith in the system. They didn't know how Brexit was going to affect, the UK as a whole. So they were hedging their bets and they were taking risk off the table by holding the British pound. Since Brexit, obviously we had a rebound in the pound and the central bank did a good job of managing it. And it's up and down still, but again, that's a financial climate, but it's down to the central bank to maintain that. And these are the primary goals of a central bank. They maintain fiscal policy, they maintain your foreign exchange rate against the dollar, they maintain foreign exchange reserves, so they've got reserves for liquidity when it's needed. And that's another important role, because when countries take downturns and when we hit recessions, the central bank is a lender of last resort. So it steps into the markets, it props up your own growth and it props up your own market. And it has those reserves to do that, and it has those tools to do that. Those tools are being diminished over time, which is why central bank digital currencies will play a vital role moving forward. I hope you've enjoyed the video. It's episode 1 of, I think, 5 for this one. And if you like, please subscribe. Please let me know. Any more questions, please ask in the comments. See you next time. Take care. Bye.